Hi everyone, this is Anil Kumar, your friendly mortgage expert. You have been hearing about terms like trigger point and trigger rate. I thought of making this video to clarify it and if it affects you or not. So first of all, if you are in a fixed rate mortgage, it doesn't affect you. You don't even have to learn about it. Unnecessary information. You don't need it. Period. If you are in a variable rate mortgage, this is something that you should know about so that you know whether it's going to affect you or not. So if you are in a static variable rate mortgage, in simple terms, if your payments have not increased in last 6 months, as we all know, prime rate has been going up since March 2022. So if your payments have not gone up, you are in a static variable rate mortgage. What it means is that in your monthly payment, bank does not increase your payment when the rate increases. What they do is they increase the interest component and decrease the principal component. So as a result, your amortization, which is the period that will take you to pay off the mortgage, gets increased. However, if you are in an adjustable rate mortgage, your payments you must be seeing that your payments have been increasing in last 6 months. Which means that whenever the mortgage rate increases, bank increases your payment to increase the principal and interest component. When the prime rate decreases, your mortgage rate decreases, and your payment also goes down. So this trigger point and trigger rate basically affects only those people who are in a static variable rate mortgage. Most likely, your mortgage is with TD Bank, RBC, CIBC, BMO, HSBC, or a credit union like Coast Capital, Envision Financial, and all those places. So it's very likely that your variable rate mortgage is a static variable rate mortgage, and this trigger point and trigger rates may affect you. But if you are in an adjustable rate mortgage, most likely Scotia or any other monoline lender like First National, RFA, Street Capital, Radius Financial, CMLS, then your payments must have been increasing, which means you are in an adjustable rate mortgage. So this trigger rate or trigger point do not affect you. Let's talk about what they are. So trigger point basically is related to your mortgage type and the value of your property. So if you paid less than 20% down payment when you purchase the property and your mortgage balance is 105% of your current market value. As we know, the value of our properties have gone down. So if your mortgage balance is 105% or more than your property market value, that means your mortgage has reached a trigger point. So that is the time when you might receive a letter from your bank, either make a prepayment, like a lump sum prepayment, or increase your mortgage payment or EMI, so that the principal that your mortgage balance becomes less than 105% of the property value. So that's the trigger point. Trigger rate is basically related to the mortgage rates. As I explained you earlier, that in every mortgage payment, there is a principal and an interest component. So if you are in a static variable rate mortgage, banks typically do not increase your monthly payment. They keep on increasing the interest component in the total payments. So there may come a point that interest rate has become so high that your payment is not even covering the interest portion of your mortgage payment. That is the time your rate has become has approached the trigger rate point. That is the time when your bank will approach you and they will ask you again to make either a prepayment so that your principal becomes less, or they ask you to increase your monthly mortgage payments, or whichever way you are paying, monthly, bi-monthly, bi-weekly, or etc. Right? So there are two different concepts. Uh, you must have already received a letter from your bank talking about it, but in case you want more information, feel free to call me at 778-996-4215 or email me at bestmortgages247@gmail.com. This is Anil Kumar, your friendly mortgage expert.